Drop everything immediately. Put down the coffee, kill the browser tabs, and glue your eyes to the screen. Check the live quote on your phone. What's the number? Probably hovering near $71. Ladies and gentlemen, it's your boy John AGI, the Asian guy from Currency Archive. If you are tracking the COMEX Spot or the London Fix, basically any mainstream Western feed, you are staring at a figure in the low 70s. And for the technical analysts out there, you are likely sketching trend lines, spotting support zones, and convincing yourselves we are just consolidating. You think silver is holding steady, but listen closely. That digital figure on your screen? It is a total fabrication. It is not just a margin of error. It is not lag. It is a straight-up mirage. A phantom pulse from a financial heart that is already flatlined? Why? Because halfway across the globe, right now in the back alleys of Tokyo, the reality on the ground is aggressively different. We have got boots on the ground in Japan confirming it. Tangible, hold-in-your-hand retail silver bars. The real wealth that shields you when fiat fails is trading at 20,000 yen. Let us crunch those numbers. Convert that at today's rates, and you're looking at about $130 an ounce. Absorb that for a second. $130. Check your phone again. $71. We are talking a $59 gap. That is an 83% markup. Modern finance has never seen a split this wide between the spot price, allegedly the global standard, and the street price, which is what buyers actually pony up. An 83% gap is not just a glitch. It is a total system crash, cardiac arrest for the market. 2% spread? That is business as usual. That keeps the lights on for dealers. 5% means buyers are hungry. 10%? That is a squeeze. But 80%? That is a broken spine. The link binding paper contracts to physical metal has been severed. The cable snapped, the car is plummeting, and impact is imminent. I can already hear the naysayers in the comments. Asian guy, stop hyping it up. Japan has high taxes. The consumption tax explains it. Fabrication costs, shipping fees. You can't equate a 1,000-ounce New York slab to a 1-ounce Tokyo coin. You are completely missing the forest for the trees. Sure, there is friction. VAT exists. Minting is not free. But overhead does not run $59 an ounce. Stamping metal does not cost that much. Shipping across the Pacific is not $59 either. Tally up every tax, every insurance premium, and every minting fee, and you hit maybe $10, $15 tops. So where is the other $45 coming from? Pure panic, scarcity. The fact that the Japanese yen is in free fall. Japanese savers, legendary for hoarding cash, are heading for the exits en masse. They are dumping yen for hard assets. Price be damned. The $71 COMEX tag means nothing to them. They know $71 buys you nothing but air. Spot price is just for cash-settled paper contracts. Street price is the cost of staying alive. And survival currently costs $130. This gap proves arbitrage is extinct. In a functioning system, banks and smart money level the playing field. If silver sits at $71 in New York and $130 in Tokyo, the big banks should be backing up the truck. They would sweep the COMEX clean at $71, drain every vault in NYC. Then they would book cargo jets, fly it to Tokyo, cover the taxes and minting fees, and flip it for $130. Even after expenses, that is a risk-free $30 or $40 per ounce on 1 million ounces. That is $30 million in free cash. Banks do not walk away from that. They would kill for those margins. So why the hesitation? Why is that gap gaping wide open every single day? Why no arbitrage? Because they literally cannot. The pipes are blocked. The chain linking a 10-pound industrial brick in a New York vault to Asian retail is shattered. Refiners cannot melt the big slabs into small bars fast enough to keep up. Not enough secure flights. And the kicker? New York supply is not as liquid as they claim. Try pulling 10 million ounces from COMEX for export today, and you trigger a default. The exchange is basically bust. Admit the vaults are empty, and price goes supernova. That is the Tokyo story. The market smells the rot. It knows the paper price is a fairy tale. So the physical market cut the cord. Bye-bye, New York. See you later, London. It is finding the actual value of silver, and that starts at $130. Your move? If you were holding paper, you're playing musical chairs on the Titanic. Get physical. Hold the metal. When the dam bursts and the cracks are showing, it will be unobtainable at any price. Check that ticker again, $71. Savor it. It's about to become a collector's item. Shut them down instantly. They would make them settle the bill in cash. That means the easy arbitrage loop is dead. The banks are stuck inside the paper matrix, while retail buyers are locked in the physical realm, and the bridge connecting them has been incinerated. We call this bifurcation. It is like the market has cracked into two parallel universes. In Universe A, the paper market, silver is a bargain. It is everywhere. You can swap it with a mouse click. The charts look terrible. The technicals scream sell. The price sits at $71. But in Universe B, the real world, silver is scarce. It is vanishing fast. You're looking at a 6-week wait for delivery. You're paying massive premiums. The chart is going straight up. The street price is $130. You have to pick your reality. If you are a paper speculator, you live in Universe A. You stare at your screen wondering why your portfolio isn't mooning yet. But if you are a physical stacker, you live in Universe B. You hold an asset that is actually trading for double the spot price in the real economy. Financial history teaches us one clear lesson. The physical reality always wins eventually. The paper game can hold the beach ball underwater for a while, but it cannot hide a physical deficit forever. Sooner or later, the paper market runs dry of metal to leverage, and the prices slam back together and they don't meet halfway. The paper ticker always races to catch the physical price. New York has to climb up to Tokyo levels. Tokyo won't drop down to New York. However, we need to check our expectations here. It is tempting to look at this spread, this 80% gap, and shout that the banks are finished. It is easy to say, hey, JP Morgan is short at $71, but the street price is $130. They are broke. The crash starts tomorrow. I see the clickbait on YouTube. I see the viral threads on X. Bankrupt, collapse, zero. I'm here to be the voice of reason. It is not that cut and dry. Sure, the banks are taking a hit. Yes, they are bleeding out. But if you believe a bank with $1.5 trillion in Tier 1 capital will fold over a few $billion in silver trades, you are misjudging the opponent. You are ignoring their defensive stats. To get how this squeeze plays out, to see why this will be a long, ugly war of attrition instead of an overnight victory lap, we need to inspect the balance sheets of these titans. We need to debunk the death myth. Because these banks aren't dead, they are just injured. And a wounded predator is the most lethal thing in the woods. Let's run the survival numbers. If you pull up the newest Commitments of Traders report from the CFTC, the data showing exactly who owns what on the COMEX, you will see a figure that looks terrifying at first glance. The commercials, which is just code for bullion banks like JP Morgan, Citibank, and Bank of America, are currently sitting on a net short position of about 40,000 contracts. Now, let's do the math. One contract equals 5,000 ounces. 40,000 times 5,000 gives you 200 million ounces of silver. That is the size of the wager. They are betting the price drops or stays flat on 200 million ounces of inventory. And right now, the price is not sitting still. It is exploding. If silver jumps from $71 to $100, a gap of about $30, you just multiply that $30 hit by 200 million ounces. That equals $6 billion. $6 billion in paper losses. In the normal world, if a hedge fund dropped $6 billion overnight, they would be wiped out. Their office furniture would be on the sidewalk. Their CEO would be testifying on Capitol Hill. It is a massive pile of cash. This is why the internet is buzzing with gossip. This is why you see posts claiming Bank of America is bust or JP Morgan is cornered. Because the calculator says they are deep in the red. The math says every time silver hits up a buck, they lose another $200 million in liquidity. But here is the hard truth that the anti-Fed crowd hates to admit. $6 billion is pocket change for these guys. You have to grasp the size of the beast we are up against. We are not battling a mom and pop shop. We are fighting systemically important financial fortresses. Let's check their armor. Let's look at Tier 1 capital. Tier 1 capital is the gold standard for a bank's financial muscle. It is their equity, their savings, the emergency fund they keep in the vault for a rainy day. JP Morgan alone sits on a Tier 1 buffer of about $300 billion. The combined assets of the big four U.S. banks top $10 trillion. So weigh the numbers. On one side, you have a $6 billion hole in silver. On the other, a $300 billion shield. The silver loss is maybe 2% of their safety net. Does it sting? Sure. Does it wreck their quarterly earnings? You bet. Shareholders will scream, bonuses will vanish, traders will get the axe. But does it destroy the bank? Does it make them shut down and hand the vault keys to the retail crowd? No, it is like you think about blowing a tire on the freeway. Is it a headache? Absolutely. Does it cost cash to repair? Sure. But does it mean you have to torch the car on the shoulder and walk home forever? Of course not. You have a spare in the trunk. You have insurance policies. You have a credit card. Well, the big banks have the ultimate black card. It is called the Federal Reserve. But there's another piece to this puzzle that everyone ignores. The hedge. We stare at the massive short positions on the COMEX and assume they are naked shorts. We think they sold silver they don't own just to roll the dice. But banks aren't gamblers. They are the house, and the house always balances the books. While they might be short 200 million ounces on the visible COMEX market, they are likely long hundreds of millions in the OTC market, the over-the-counter shadow world the public never sees. Consider how a bank actually works. The silver operation in Mexico mines the metal. They need to lock in prices to pay wages. So they ring up JP Morgan and say, I will sell you 10 million ounces at $70. The bank says, deal. Now the bank is long 10 million ounces of physical metal or holds a forward contract. But JP Morgan does not want to gamble on price swings. They just want the commission fee. So what is the move? They hit the COMEX and short 10 million ounces. Now they're neutral. If the price rallies, they lose cash on the short, but they gain equal value on the miner's contract. The two positions wash out. That 40,000 contract short you see on the CFTC report is largely just insurance against real physical metal they have secured from miners. So when the price rips to $100, sure, they bleed $6 billion on the COMEX, but their miner contracts gain that same $6 billion. Net loss? Zero, or close to it. Now, I'm not saying they are perfectly hedged. They play games. They take risks. They definitely expose themselves sometimes. There is likely a speculative chunk of that short book that is bleeding out. Maybe they are unhedged on 50 million ounces. That is a $1.5 billion hit. That stings. That is real pain. This explains why we see sudden liquidity injections. That is why we see panic in the repo markets. They need immediate cash to cover margin calls on the shorts while they wait for the long contracts to pay out. It is a liquidity crunch, not a solvency crisis. There's a massive difference. A liquidity crisis means you are wealthy, but your wallet is empty right this second. A solvency crisis means you are bankrupt. The banks are in a cash squeeze. They need funds now to feed the COMEX beast, but they aren't broke. Understanding this is vital for your strategy. If you think the banks are going belly up tomorrow, you might make reckless moves. You might buy call options expiring next week, thinking the collapse is here. And then the banks will just move capital, cover the margin, survive the day, and use their algos to hammer the price back down to $70 to shake you out. They have the endurance to fight a war of attrition. They can absorb the pain far longer than you can stay solvent using leverage. This is a painful deleveraging. That is the right phrase. They are unwinding bad positions. They are eating the losses. They are stepping back. Why do you think silver jumped from $20 to $71 recently? Because the banks stopped the suppression. They realized it is too costly to fight the trend. When silver was $20, they could smash it easily. At 71, with a shortage looming, smashing the price burns billions in collateral. So they are retreating. They are letting the price run, but they are doing it in a controlled, managed style. They are managing the retreat. They aren't dying. They are repositioning. And never forget the ultimate safety net, the rule book. If things really get chaotic, if silver hits $200 overnight and a $6 billion loss turns into a $60 billion disaster, do you think the exchange will let the banks fail? Do you think the government will let the financial system crumble over a shiny rock? No, they will change the rules. We have seen it happen. In 1980, when the Hunt brothers cornered the silver market, the exchange switched the rules to liquidation only. You could sell, but you couldn't buy. They broke the Hunt brothers to save the banks. In 2022, when the nickel market blew up on the LME, they simply canceled the trades. They rewound the clock. They said those deals never happened. If silver goes vertical to a point where it threatens the existence of JP Morgan, the COMEX will declare force majeure. They will halt trading. They will force a cash settlement at a fixed price. They will say, okay, the price is $75. Everyone settle here. Market closed. This is why I tell you, avoid their game. If you hold a paper contract betting on a crash, they can rewrite the contract terms. If you hold physical metal, they cannot change the laws of physics. They cannot delete the bar in your safe. But as long as you play in their casino, the COMEX, the house always wins. Or at the very least, the house never dead on arrival. So kill that bankruptcy narrative right now. It is a fairy tale. The banks are going to make it. They will walk away with a black eye and lighter wallets, but they will survive. But here is the kicker. Their survival strategy, their retreat, is the exact catalyst silver needs to launch. They aren't the brick wall stopping the price anymore. They are turning into a speed bump. They are moving aside because the price of rigging the game now outweighs the rewards of rigging it. And why the sudden spike in cost? Why is shorting the market suddenly a suicide mission? It comes down to the physical reality, the one variable they cannot hedge, cannot print into existence, and cannot regulate away. The supply crunch. Banks can shuffle paper contracts all day. But the game ends when the actual metal stops showing up at the loading dock. And that is exactly the situation today. The real danger to their suppression game isn't a balance sheet in New York. It is the Great Wall. As of today, January 1st, Beijing's new laws are live. And while we were distracted by bank stocks and premium spreads, the Chinese government quietly locked the door. This is the structural fracture that rewrites the math for the next decade. Let's talk about the pivot. Let's talk about the red dragon. This brings us to the turning point. The moment the story shifts from financial tricks to hard geopolitical facts. We spent the last few minutes dissecting Western balance sheets, arguing if a $6 billion hit is a death blow or just a flesh wound. But while we watched the paper fire in Manhattan, the real arsonist was striking a match in Beijing, because today is January 1st, 2026. Check the date. It isn't just a new year, it is the dawn of a new era in resource nationalism. As of this morning, China's new export regulations on strategic dual-use metals are the law of the land. With a single signature, the planet's biggest producer and consumer of refined silver has effectively built a fortress around its supply. You need to grasp the gravity of this. The media calls it export licensing. They are using soft diplomatic language. They say, oh, China isn't banning silver. They just want a license for quality assurance. Don't be a sucker. Licensing is government code for a soft ban. Under these new rules, which we have translated and studied, the only groups permitted to move silver out of China are the mega refiners, the massive state-owned giants that answer directly to the party. The hundreds of private shops, the recyclers, the trading houses that used to flood the global market with excess metal, they are cut off. No license for them. They are forced to dump their metal locally. And the mega refiners? You think they will export? Technically they can, but practically they won't. Why? Because their orders have changed. For 20 years, their mission was profit. Their job was to refine silver and sell to the highest bidder, whether that was a tech firm in California or a broker in London. Today, their mission is national security. Their job is to guarantee that the Chinese solar sector, the EV manufacturers, and the military-industrial complex get first dibs on every single ounce of metal produced inside the People's Republic. They only export leftovers. And here's the scary part. There are no leftovers. China is already running a massive internal silver deficit. They mine roughly 3,500 metric tons annually, but their industrial beast, which churns out 80% of the world's solar panels, eats over 6,000 tons a year. Run the numbers. 3,500 minus 6,000. That is a hole of 2,500 tons. In the past, they plugged this gap by importing ore, refining it, and sometimes shipping out finished bars to balance the books. But now, with solar demand going parabolic, especially with new TOPCon and HJT panels that guzzle 50 to 80% more silver per watt, their domestic hunger is unquenchable. They need every ounce they dig up and every ounce they can bring in. Sending silver abroad right now, from Beijing's view, is practically treason. It is handing the fuel of the future to a rival. So the wall is real. It isn't made of concrete. It is a regulatory wall that says no Western buyers. Bullion banks like JP Morgan and tech giants like Tesla that relied on Chinese flows to balance the global market are waking up to a dial tone. They are calling Shanghai and hearing, sorry, license denied. Sorry, the ministry flagged this shipment. Sorry, domestic needs took the whole lot. This locks in a permanent shortage for the West. You have to realize how brittle the Western silver market actually is. The US doesn't mine enough to survive. Neither does Europe. We are deficit zones. We depend on imports from Mexico, Peru, and China just to keep the grid online. But if you knock China out of that lineup, if you kick one of the three legs out from under the stool, the whole thing crashes. The West is left fighting over whatever scraps Mexico and Peru can offer. That means premiums out here have to skyrocket and stay there just to lure in any metal. This isn't some temporary glitch that clears up in a week. This is a total rewiring of how metal moves around the planet. For decades, silver has flowed east to west. As of today, that river runs dry. Hell, it might even flow backward. We could see China throwing aggressive bids at Mexican silver, going toe-to-toe with American buyers. And that is when industrial panic shifts from a slow simmer to a full-blown forest fire. We have covered Samsung and Tesla before, but forget them for a second. Look at the second-tier players. Look at the folks building medical tech, rolling out 5G towers, the defense contractors. They don't have the political pull of a Tesla. They don't have Apple's massive war chest. They lived by the open spot market, assuming they could just click a button and snag silver at the London fix plus a tiny markup. That world is dead and buried. Now they are staring at a screen saying $71, while Shanghai is trading at 110 and Tokyo is hitting 130. They're watching global stock get vacuumed into an Asian black hole. This triggers a massive psychological shift. Inventory hoarding. In supply chain terms, when a key part gets scarce, you ditch just in time for just in case. You panic buy. You overorder. Need 10,000 ounces for February? You book 20,000 just to be safe, because storage fees are a tiny price to pay compared to the fatal cost of a factory shutdown. This behavior just dumps gas on the fire. It is a self-fulfilling prophecy. Once one guy starts hoarding, everyone else has to follow or starve. We are already seeing the cracks form. Phantom demand is exploding. People are buying not to use, but just to survive. And this wave of panic demand is crashing into a market that just lost its main supplier. That right there is the detonator for the squeeze. Banks can rig paper prices on the COMEX because that is just a closed loop of digital promises. But they cannot rig the fact that a plant in Ohio needs physical silver for a cruise missile chip, and that silver is locked inside a Shanghai vault that just slammed its doors shut. A bank cannot print a silver bar, and it sure as hell cannot force Beijing to export. For the first time ever, Western financial elites are totally helpless against physical laws. They can print dollars to bail out short sellers, but dollars are worthless if there's nothing to buy. What good is $1 billion if the seller says not for sale? This splits the industry right down the middle. Factories inside China, like Tesla's Shanghai Gigafactory, are fine. They can tap into Chinese metal. They pay the local rate and keep humming. But factories in the US or Europe, they are in the kill box. They are severed from that Chinese tap. They are forced to scrap for the shrinking Western supply. This will force premiums in the West to spike until they match the East. It is inevitable. If silver is 130 in Japan, why would a Mexican miner sell to a US refiner for 71? They won't. They will ship it straight to Tokyo. Money chases the best return. Commodities go where the payout is highest. Unless COMEX prices rise to match Asia, the COMEX will be drained dry. Miners will ghost New York. Refiners will skip London. They will sell direct to desperate Asian buyers. Which brings us right back to the banks. We said in part 2 they are not dead because of Tier 1 capital. True, they have cash, but cash doesn't solve a blockade. J.P. Morgan can cut a check for $5 billion to cover a bet. But if the client demands delivery, if they say, I want the metal, not your paper, J.P. Morgan is screwed because they cannot get an export license from China either. Their capital protects them from going broke, but it doesn't protect them from defaulting on delivery. It doesn't save them from the shame of telling a client, we are empty. That is the Achilles heel. That is the thermal exhaust port on the Death Star. Inventory. Banks can survive a price squeeze. They cannot survive an inventory squeeze. If COMEX vaults hit empty, if registered stocks hit zero, the game is over. The illusion of infinite liquidity shatters. And thanks to that China wall, the refill rate for those vaults just flatlined. No fresh metal is coming from the east to save them. They are on their own. They are fighting a war with whatever ammo is left in the bunker, and the supply lines are cut. So what is the actual ammo count? How close is the clock to midnight? We keep hearing numbers thrown around. Forget the headline numbers of 100 million or 50 million ounces. The only figure that actually matters is the inventory ready for immediate shipment to the registered category. When you dig into the fine print of the COMEX report, you realize the banks don't actually own most of the silver sitting in those vaults. That metal belongs to investors with diamond hands who aren't selling. The actual liquid supply left to stop this panic is terrifyingly scarce. We aren't talking about an ocean here. It is a drying puddle under a scorching sun. We are skating on thin ice. Let's look at the hard inventory data that proves the COMEX is completely running on fumes. Once you see how empty the tank really is, you'll understand why premiums are hitting 80%. You'll see why the market is in full-blown panic mode. Let's crack the vault wide open. If we could force those massive steel doors in New York to swing wide, we wouldn't find a fortress of endless riches. There are no mountains of silver bars stacked to the ceiling, ready to flood the market and crush the speculators. You would find a hollow echo. It is a crime scene where the evidence has been stripped away, bar by bar, truckload by truckload, until there's nothing left but dust. We need to have a serious talk about the number 38 million. According to the latest Daily Warehouse report, which they slipped out quietly while the media was distracted by New Year's parties, the total registered silver in the COMEX system has collapsed to just 38,200,000 ounces. Now, to the average guy, 38 million ounces sounds like a dragon's hoard of treasure. But you have to view that number against the global backdrop. The world devours roughly 1,100,000,000 ounces of silver every single year. That averages out to a burn rate of about 3 million ounces every single day. Do the math. 38 million ounces divided by 3 million a day, 12 days. That is all she wrote. The global benchmark for silver pricing, the exchange that supposedly dictates value for the entire planet, is sitting on less than a 2-week supply. If the mines shut down tomorrow, or the transport ships stopped sailing, the COMEX would be bone dry in 12 days flat. That is not a buffer. That is not a reserve. That is thin ice, and it is cracking under the massive demand we just broke down. But the situation is actually way worse than the headline suggests, because the banks are playing a shell game to make the inventory look healthier than it is. They love to point at the total inventory, which usually hovers around 270 million ounces. They say, look, there's plenty of silver, no need to panic. But they are lying to you by omission. Inside that total number, there are 2 buckets, eligible and registered. Registered is the metal actually on the block for delivery. It has a warrant attached. It is prepped and ready to sell to fulfill a contract. That is your 38 million ounces. Eligible is everything else. That is roughly 230 million ounces. But eligible just means the metal meets purity standards. and is sitting in the vault, it does not mean it is for sale. That metal belongs to private investors. It belongs to family offices. It belongs to people like you and me who just pay the vault a fee to store it there. The banks cannot touch it. They cannot deliver it to cover their shorts unless the owner gives the green light. And ask yourself this. If you own silver in a COMEX vault and see the price in Japan is $130, but the bank wants to pay you $71, are you going to sell? No way. You're going to hold or you're going to pull it out. So the eligible pile is effectively frozen. It is dead weight. The only liquidity in the system is that tiny shrinking pile of 38 million ounces. In the registered category, this is where the economic law of gravity kicks in. We call it Gresham's Law. You might remember it from Econ 101. Bad money drives out good. But in the context of the silver market, it means fake paper prices drive out real physical metal. When a commodity is priced artificially low, when it is subsidized by paper manipulation, the market will drain the physical supply until the cupboards are bare. Think about it. The COMEX is essentially a discount store selling silver for $71. The rest of the world, Japan, China, the UAE, values that same silver at $100 or more. What happens when a store sells iPhones for $500 when they are worth $1,000 everywhere else? You get a run on the store. The smart money, the arbitrage sharks, the industrial buyers, the sovereign wealth funds, they will stand for delivery on the COMEX, not because they want to crash the system, but because it is the cheapest place on earth to buy the metal. They are legally looting the vault. They are using the bank's own suppression scheme to strip mine the exchange of its assets. This is why the inventory is crashing. It is not an accident. It is the direct mathematical result of the price suppression. The banks are victims of their own success. They suppressed the price so effectively that they made silver the most undervalued asset on the planet. And now the world is backing up the truck. Whenever they hammer the spot price down to $71 to defend their downside, they mess up big time. All they're actually doing is signaling a massive feast for the stackers, practically screaming, "Blue light special, get it while it's cheap." And the market is listening. Outflows are picking up speed. We're tracking a surge in warrants and demands to pull bullion straight out of the depository network, reaching volumes unmatched since the chaotic squeezes of 2021. Except we're kicking off from rock bottom this time around. And that's what should keep the short sellers awake at night. The resupply lines are severed. Historically, whenever registered stockpiles dipped near 30 million ounces, you'd see a small rally that would suck in inventory from London or Shanghai to top things off. Producers would expedite shipments. But right now, we already proved in part 3 that the dragon has shut its gates. The East isn't setting a single ounce. Meanwhile, those holding eligible stock are staring at CPI prints. They see the geopolitical tension. They see the street premiums. No way they're unloading at $71. They're holding out for the big 100. So the vaults stay empty. It's a one-way street out the door. Imagine a tub with the plug pulled and the water main cut. It's just simple math. Eventually it runs dry. So what's the play when we hit rock bottom? When registered inventory free falls from 38 million down to 10 and finally nothing? Is it the apocalypse? Does the exchange implode? Hardly. The house always wins. This is where the paper market plays its ace in the hole. Expect them to announce a freeze on physical redemptions. They'll blame supply chain snarls or abnormal trading activity. They'll trigger the force majeure print in the fine print and tell the folks standing in line for delivery. Apologies, but we're out of bars. However, great news. We're cutting you a check for the cash value instead. They'll close you out at $71. You'll be forced to accept the very fiat money you were trying to hedge against. That's a default, plain and simple. The mainstream news won't call it that, though. They'll label it an administrative settlement. But real sound money advocates know the truth. If you paid for a truck and the dealer pocketed the cash, only to say, "Whoops, no truck. Here's a refund," you'd be livid. Sure, at least you got your principal back. But in this game, a refund is a catastrophe, because while you're clutching your $71 payout, the actual street price for physical bullion, the cost to really acquire the goods will be rocketing toward $150. You'll be locked out permanently. You're stuck with melting paper money while the asset launches into orbit. That's why these stockpile numbers are critical. 38 million ounces is our doomsday clock. Every single bar that exits takes us one step nearer to that forced cash out. The whales know it too. That's why the bleeding is picking up pace. It's classic musical chairs. You've got endless paper claims chasing just 38 million ounces of hard assets. When the song ends, and it's fading fast, only the guys holding the physical metal are safe. Everybody else gets a worthless IOU. And don't think this will be a slow burn. During a run, vaults don't empty in a straight line. They collapse exponentially. The second the news breaks that registered silver has dipped under 20 million, panic sets in. Funds that typically just flip contracts will demand, "Deliver the physical immediately." Manufacturers will scream, "Buy it all, I don't care about the price." That last 38 million could evaporate in days. We witnessed it with nickel. We watched it unfold with palladium. When the floor gives way, it happens instantly. So you've got banks hemorrhaging cash flow while sitting on capital buffers. You've got an Eastern supply freeze choking off new imports. And you've got exchange vaults running on empty, holding barely a fortnight of cover. It's the ultimate setup for a massive price reset. But don't expect a vertical line to the moon. The establishment won't just surrender. They'll battle back. They'll deploy every dirty trick they have to make the journey to $100 as brutal, choppy, and disorienting as they can. They want you to fold before the jackpot hits. What's their strategy? What's the playbook for 2026? How do we navigate from 71 to 100 without getting wiped out? We need to study the art of the fighting withdrawal. We need to understand this war of attrition, because the coming year isn't going to be fun. It's going to be a slog. Let's analyze the path ahead. The metrics are undeniably positive. If you fed these numbers into an algorithm, silver would spike to $100 by dawn. But markets aren't clean models. They're war zones. And the opponent you're facing, the heavy hitters running the bullion desks and the exchange operators, haven't thrown in the towel just yet. They are falling back. But any soldier knows a retreating enemy leaves booby traps. So I need to dismantle a dangerous myth right now. There is a delusion spreading online that just because the vaults are running empty and the short sellers are stuck, we are about to see prices go vertical. People actually believe they'll wake up Monday to see silver sitting at $100. They're expecting a straight shot to the moon that fixes their bank account overnight. I am telling you point blank, that is not happening. The road to triple digits in 2026 won't look like a rocket launch. It is going to be a slog, a nasty, choppy, draining siege designed to force you out of your trade before the payout. You need to grasp the distinction between trend and control. The banks have lost the trend. The massive supply gap from China and draining vaults mean price appreciation is inevitable. Market physics guarantee it, but the banks still dictate the speed. The house still runs the casino, they set the leverage rules, they own the trading bots. And they will use that power to ensure the climb from $71 to $100 is painfully slow and absolutely brutal for anyone on margin. What is their strategy? What is left in the arsenal? First up is volatility. Get ready for the price action to get violent. We are talking days where silver rips $5 higher at breakfast and dumps $7 by lunch. Why? Because these banks know retail traders are addicted to leverage. They know you're buying calls. They know you're gambling on futures with 10-to-1 debt. So they will engineer sudden, terrifying plunges, flash crashes, specifically to hit your stop-loss orders. They will hammer the price from $75 to $68 in 10 minutes just to liquidate the bulls, then let it drift right back to $75. That is called stop hunting. It is how they manufacture liquidity. They scare you into selling low so they can buy your shares to cover their own shorts. If you're holding paper derivatives, you're picking up dimes in front of a steamroller. You will get flattened. Their second weapon, and this is the nuclear option, is hiking margin requirements. We're already seeing the early signs. The COMEX has quietly bumped up the cash collateral needed to hold a contract twice in just the last month. They aren't done. When silver touches $80, they will double the requirement. At $90, maybe triple it. Why? They will claim it is for market safety. But the real goal is pricing out the little guy. If it costs $10,000 to control a contract, the average trader can play. If they jack that up to $50,000 overnight, that trader gets a margin call. He is insolvent. He has to fold. And who has the liquidity to meet those new rules? The banks. By spiking margins, they shake out the weak hands, leaving only the institutional whales at the poker table. They are effectively turning the rally into a gated community, clearing out the rabble so they can ride the wave alone. This is exactly why I warned you in the last video about the dying bank narrative. If you bet on them collapsing tomorrow, you will lose. They have the deep pockets to survive the very margin hikes they enforce. You do not. So what does the chart actually look like? I think we are looking at a staircase pattern. We won't teleport to 100. We will grind to $80, then chop sideways for a quarter. It will be dull. It will be maddening. The headlines will scream the silver bull run is dead. This boredom zone is a trap to make you walk away. They want you to dump your metal and chase Nvidia or crypto. Then, once the tourists have left, we gap up to $90 while you sleep. Then another dip, another long wait. It is an exhaustion machine. They want to break the buyers mentally. They want holding silver to feel like a punishment, not a win. But while the paper market plays these mind games, the physical reality tightens like a vice. Remember those 38 million ounces in the vault? Well, the price goes nowhere. That inventory keeps draining. 35 million, 30 million, 25 million. The gap between the paper casino and the physical shortage will keep stretching until the rubber band snaps. The target is $100. I'm certain we see triple digits in 2026. The structural gap from the China ban is around 200 million ounces annually. Investors are soaking up another 100 million. Mine output is stagnant or falling. The math is absolute. We need a price that kills consumption. We need a price high enough to make people melt down their family heirlooms. $71 won't do it. $80 won't do it. $150 might start to trigger that. So the price must go there. But it happens on the bank's schedule, not yours. They are currently managing a strategic exit from their short positions. They are quietly unwinding those downside bets during every pullback. And the moment they flatten out, once JP Morgan and their cronies have scrubbed those poisonous short positions from their ledgers, that is the exact moment they unleash the price. The second they flip long, they will transform into the most aggressive buyers on the planet. Watch them mobilize their propaganda machine to hype the rally. They will suddenly start projecting targets of $200. They intend to surf the tsunami up just as profitably as they rode the crash down. Banks have zero loyalty to low prices or high prices. Their only loyalty is to winning. At this moment, they are cornered on the losing team. All this volatility in 2026, that is just the friction of whales changing lanes. So how do you navigate this turbulence? How do you maintain your grip when the charts plunge $10 in 60 minutes? How do you keep the faith when the headlines scream game over? You have to quit playing by their rules. Stop viewing the spot price as a value metric and start seeing it as a flash sale notification. Think like a manufacturer, not a day trader. Samsung does not liquidate their silver stockpiles just because the quote dropped $5. They hoard it because it is essential. You need to hoard your stack. Because you know the fiat system is crumbling, supply is evaporating, and a massive repricing event is mathematical destiny. We are witnessing the death throes of a 4-decade suppression scheme. These eras never end with a whimper. They end with chaos, confusion, and brute force. The establishment will kick and scream, they will rig the regulations, they will jack up margin requirements. But they cannot counterfeit physical metal. As long as that reality holds and the vaults keep draining, the outcome is set in stone. The only unknown is the route we take. So buckle up. Avoid margin debt like the plague. Do not try to outsmart the high-frequency bots. Just sit on the physical asset. Because when the smoke clears and the banks have finished swapping jerseys, we are heading to valuations that do not even exist on today's graphs. This leads us to the final component, tactics. We have analyzed their moves. Now let's focus on your countermove. We discussed the Tokyo trap and the insanity of paying 80% premiums. But if Japan is a ripoff and New York paper is a lie, where is the entry point? How do you profit from this broken system without getting slaughtered? There is a narrow window open right now, a chance to leverage the COMEX rigging for your own gain before the lockdown. Let's finalize this with a battle plan. Here's the strategy. First, let's address the Japan situation because that is the number one blunder I see people making currently. When you read reports about Japanese investors shelling out $130 an ounce, your gut reaction is panic. You feel the urge to think, if they are paying $130, I need to buy immediately before it hits $200. You must suppress that urge. Paying an 80% markup over global spot is not investing. It is financial self-destruction. If you pick up a bar for $130 while the rest of the planet values it at $71, you're instantly in the red. You are donating half your capital to the middleman, the mint, and the government. That premium isn't value. It is a tax on your fear. The crowd in Tokyo isn't buying silver because they are genius traders. They are panic buying because they are terrified their yen is about to dissolve. They don't care about the price. You do. You are a tactician, not a victim. Do not chase the herd. Let the mob pay the panic tax. We are playing a smarter game on this channel. The opportunity right now, the ironic gift the manipulators have accidentally handed us, lies within the COMEX suppression itself. Look at what the banks are doing. They are burning billions of their own cash to pin the paper price down at $71. They are doing this to survive, to defend their shorts, and to stop a chaotic price explosion. But their desperation is your discount. By crushing the spot price, they are effectively subsidizing your physical accumulation. Yes, there is a premium. You might pay $5 or $8 over spot for a standard bar. But run the numbers. $71 plus $8 is $79. Compare that to the Tokyo price of $130. You are securing the exact same element for a $50 discount, simply because you are buying in a market where the rig is still active. This is the trade of the decade. You are essentially arbitraging their fraud. They are keeping prices low to hide the truth. Every ounce you grab at $79 is highway robbery. You're extracting wealth from a system designed to cheat you. The strategy is not to wait for the manipulation to break. The strategy is to exploit the manipulation while it still exists. Because once the COMEX fails, Once registered inventory hits zero and they declare force majeure, that spot price vanishes. The discount window slams shut, and suddenly the pricing in New York is bound to chase Tokyo's pricing, and you want to be the smart money buying in at 79, not the sucker waiting in line to pay 130. But here is the most important warning I can give you. This strategy is worthless unless you are stacking physical silver. I cannot emphasize this enough. Stay away from paper assets. Forget SLV, avoid unhedged mining stocks, and do not touch futures contracts. And for heaven's sake, keep your capital out of unallocated pool accounts at the big bullion banks. Here is the reality. The banks are trying to play you. They will claim that buying the real metal is too costly. They will complain about premiums and shipping fees just to sell you on their unallocated digital silver instead. They offer it at exactly $71 spot price with free storage. It sounds like a steal, right? It is a total bait and switch. Unallocated means you do not own a single specific bar. You just own a paper promise against the bank's general stash. You're nothing but an unsecured creditor. If that bank goes belly up or runs dry, you get zero metal. You just get to stand in line with every other creditor fighting for pennies. And do not forget point 4. The vaults are bleeding out. Inventory is sitting at historic lows. If you are sitting in an unallocated account, you are basically funding the very banks betting against the asset you think you own. When the squeeze triggers, they will just cash you out. They will hand you $71 and tell you to have a nice life. Meanwhile, the actual physical bars will be skyrocketing to triple digits. You might make a profit on paper, but your purchasing power will be incinerated. You will have completely missed the boat. The only way to win this fight is to take delivery. If you don't hold it, you don't own it. That saying exists for a reason. When that bar is in your personal safe, counterparty risk hits zero. JP Morgan can collapse. The COMEX can shutter its doors. The Chinese government can lock down exports. It makes no difference. The metal in your hand remains silver. It is immune to their regulations and their failures. That is exactly why we pay the premium. That extra cost is the price of independence from the banking cartel. So here's your playbook for the next 12 months. Step 1. Tune out the daily noise. The banks will hammer the paper price. They will engineer flash crashes and try to shake you out of your position. Stop using the spot price to measure your net worth. Measure your wealth in ounces. Weight is the only scoreboard that matters. Step 2. Buy the blood. When they smash spot down to $68, do not sell in a panic. Head to your dealer and stack more. Use their manipulation to lower your average cost. Step 3. Watch those registered inventory numbers like a hawk. That is the true doomsday clock. When that number dips under 30 million ounces, we are in the final stretch. That is your signal to stop accumulating and hold the line. We are witnessing the slow motion demolition of the legacy financial system. The banks are wounded, make no mistake. They are hemorrhaging billions and their vaults are running on fumes. Their credibility is destroyed. They are fighting a losing battle, trying to manage the collapse of their own price suppression game. Sure, they are powerful. They have deep pockets. But they are on the wrong side of history. You cannot artificially suppress the price of a strategic resource forever when global supply is evaporating. The laws of physics will always beat financial engineering. The squeeze is happening. This is not some fringe theory. It is a mathematical inevitability caused by the massive deficit we just covered. China has already shut the door. The industry is panic buying and the COMEX is running on empty. We are heading for $100 and beyond. This is John A.G. The analysis is complete. The plan is locked in. The window of opportunity is still open, but it is slamming shut. Ignore the noise. Stack the metal. I will catch you on the flip side. Make sure to like, subscribe, and share. Time is running out. Do not buy the hype. Buy the silver. See you on the other side. Like, subscribe, and share.